Um, Hi, everybody. This is a short, very short talk on the stock market for physicists. Um, so let's see if I can manipulate this thing. Some disclaimers. I've never taken a course in finance or economics. I'm not a stockbroker. And I have no special advice today. I don't know which stocks to buy or sell. I don't know whether the market's going up or down. What follows is advice of a very general nature, but I think it's advice that is of use to anyone who doesn't already know this advice. First of all, there's a famous and marvelous and very good investor in Omaha, Nebraska, called Warren Buffett. He's called the Oracle of Omaha. He's made millions of dollars for millions of people. And he's also a wonderful man. He joined with Bill Gates and donated a large amount of his fortune to charity. He said many times that he can't predict where stock prices are going. And so I don't try. And in fact, I just relax about which way the market's going from day to day. And his advice to all of us and my advice to you is don't try to predict the stock market. Don't try to predict whether a particular stock is going to rise or fall in the short term. Somebody wise once said that the stock market is a voting machine in the short term, but in the long term, it's a weighing machine. In fact, I've grown to have a certain affection for the stock market because there are lots of people whose opinions and behavior I'm not terribly happy about. But the stock market always does the right thing eventually. And of course, what counts is the long-term trend. Warren Buffett's view is that he buys a stock thinking that he will hold it forever. And I think the best thing is to invest for the long term. Now, history suggests the long-term trend of stock prices is up. The Dow Jones Industrial Average back in, let us say, say the year 1966 or 1968 was 1,000. Today, it's over 34,000. So that's an enormous increase. It's a factor of 34. That's an increase of 3,400 or 3,400%. But that's, of course, over a period of 63 years, 60, well, not 60, 50 years or so. Another thing Buffett said is that if people don't know what stocks to buy, then they should buy shares of an index fund. And in particular, he recommends a fund, index funds that track the S&P 500. And the S&P 500 is simply the average price of all shares of all the shares of the 500 largest corporations. I guess the largest corporations listed on the New York Stock Exchange, but it might be more general than that, but I think it's listed on the New York Stock Exchange. Well, no, it couldn't be that. It must simply be the largest 500 corporations, because Intel, for example, is on the NASDAQ, and so is Google and several other very important companies that are certainly in the S&P 500. An easy way to follow Buffett's excellent advice is to buy shares of an exchange-traded fund, which people call an ETF. And the ETF in question is something has a ticker symbol SPY. And when I have money that I don't know what to do with, I put it into the SPY. Although sometimes I instead buy shares of Buffett's conglomerate, which is called Berkshire Hathaway. My advice is to use a discount broker. Fidelity, Schwab, TD Ameritrade, now part of Schwab. Let one buy and sell shares of corporations at no charge. That's a huge improvement. 40 years ago, it was virtually impossible to avoid paying a commission of $200 when spending, say, $3,000 on the purchase of, say, 100 shares of some company. And the brokerage firm that got that money offered nothing in return, essentially. Fidelity even lets one buy slices of shares. Probably Schwab does too. I haven't checked. You can buy 1/10 of a share of SPY for $44, for example. TD Ameritrade even has real people who answer the phone late at night and on weekends. That's, I think, pretty amazing these days. Full service brokers, on the other hand, offer bad advice and charge big fees. So avoid full service brokers. Use, I don't know, Fidelity, TD Ameritrade, Schwab. What I learned from Peter Lynch, who basically made Fidelity what it is today. Peter Lynch encourages people to keep track of the products that they buy, and in particular, the ones that they actually like, and to consider buying shares in the corporations that make the products that they actually like. And that's quite good advice. One can combine that advice with something I learned from my thesis advisor, Roy Glauber, who won the Nobel Prize in Physics in 2005. Glauber once explained to me that the people who manage big mutual funds and huge private fortunes can't invest in small corporations. And that's obvious because these people are moving, are trying to manage funds that are tens or hundreds of billions of dollars. And if they put $1 billion into a small corporation, the stock goes through the roof. So they have to avoid small corporations. And this, for example, is why when Warren Buffett was first running Berkshire Hathaway, his he improved the value of the fund just extraordinarily. That was because he could buy and sell the shares in small companies. But once he had grown Berkshire Hathaway into one of the largest corporations in the world, he had to ignore small firms. And the problem then is that if you have if you invest in $1 billion corporation, it can increase in value by a factor of 100. But a corporation that's already $1 trillion corporation cannot increase by a factor of 100 because, for example, the GDP of this country is only about 20 or 25 trillion dollars. So there's a limit to how quickly large corporations can increase. So that's really important insight, because you see these huge firms on Wall Street really have good information, and they have much more information than ordinary investors have, and they get that information much more quickly, and so they know a great deal about corporations, what to buy, what to sell. And so if they had the time and the patience and the interest in investing in small firms, they'd squeeze us all out of small firms. But of course they don't. And so they leave them to ordinary investors like us. And there's another, now if you combine that with what Peter Lynch said, the result is that if you see a product that you really like and it's made by a small corporation, then you should think about buying stock in that small corporation. Physicists have special advantages in the stock market. One is that every physicist is good at numbers. That is a huge advantage in finance. Secondly, every physicist understands technology far more than people on Wall Street. That also is a huge advantage. Moreover, as a student or a working physicist, you occasionally will encounter a product that's amazingly useful and available at a reasonable price. If that product is made by a small corporation, you should think about buying shares in that corporation. Let me give you some examples. These are examples of my own investing history, which I've sometimes done the right thing, sometimes done the wrong thing. Intel, I don't know, about 40 years ago, I was watching Wall Street Week with Louis Rukeyser, which was a PBS program that ran for maybe 20 years until Rukeyser finally retired. And there's been nothing like it since. Rukeyser was excellent. And the marvelous thing was that he was concerned about ordinary investors. And on one of the programs, he had a guest who remarked that, or maybe Rukeyser himself remarked that IBM had just invested $50 million in Intel, which then was a very small company. And so I thought, well, if IBM thinks Intel is worth investing in, I should invest in Intel. And I bought 100 shares for around $3,000. And the investment grew by a factor of, I don't know if it's at least 10, possibly 100. Maybe not 100, say 20. Google. There was a brilliant Russian postdoc at UNM 30 years ago and 20 years ago named Dmitry Sergatskov. And he told me to buy Google on the IPO. I wish I had. I considered it, but I let it go. Of course, I should have bought Google on the IPO. He also told me in 2003 to buy Apple. Apple was trading at around, I don't know, 10 cents a share or $1 a share. I don't know what it was, a trivial price. But I had no experience with Apple. I never had owned an Apple device, so I didn't do anything. I considered it seriously, but I didn't invest. And of course, I missed out enormously. I did eventually, about 7 years later, I bought 100 shares of Apple, which have since increased in value so much that the profits were far exceeded all the costs of all the computers and devices of Apple that I bought. So that's one good choice, two bad choices. I spent a sabbatical at NIH, and there I heard a workshop. I sat through a workshop on messenger RNA, and I realized that it was going to be very, very important. And so when I heard that Alnilam was a corporation that was small and doing good things in RNA, I bought some shares of that. And they're up, I don't know, factor of 10 or something. I went on a hike once with a very smart colleague, Jim Thomas, who told me I should get videos from Netflix. And so I listened to him. He was really excited about Netflix. And so I listened to him and I started renting videos from Netflix. What I should have done, of course, was to buy stock in Netflix. Didn't occur to me. I missed it. So now I am 1, 2 for 5. Also, while I was at NIH, I heard a seminar by a physicist, possibly an electrical engineer, but I think he was a physicist, about computer science. And what he pointed out was that in 2003, Intel and other chip makers had pushed their products about as far as they could go, because going down from, at that time, I think maybe it was 20 or 30 nanometers, down to 10 nanometers, and then down to 5 nanometers, and then down to 1 nanometer. At some point, they were going to have to stop. And I find it hard to imagine how they can go below 1 nanometer. And I think they're presently at 3 nanometers, maybe 2. And his conclusion was that the future of high-speed computing was parallel computing. And so I was on a hike with a graduate student named, oh God, I'm terrible with names. He was a graduate student in biophysics, and he was very excited about some GPUs, some graphic processing units that NVIDIA was making, because NVIDIA had developed a parallel processing language called CUDA that could be used to program these GPUs. And that's what they were doing in the lab he was working in. They were using NVIDIA chips to do calculations in parallel that they could never do on an ordinary computer. And so on the following Monday, I bought 200 shares of NVIDIA. I think they were, I don't know, $20 a share, something like that. Malik is the person's name. Michael Malik was the very bright graduate student who gave me that valuable advice. So this was a case where I actually did the right thing. Also, because I knew about RNA from that experience at NIH, I bought shares in BioNTech and Moderna when COVID started, and they've done pretty well. I was a little late actually with Moderna, but it still was a good investment. So I don't know. I'm probably 1 out of 2 here, and I think that's sort of the way it turns out typically. Let's see. I think that's basically all I have to say, and so I'm going to stop now. And I actually see that one of my phones is ringing, and so I need to stop and answer the phone. George, if you want to hang on, I'll be able to talk with you after I make the phone call.
There's about a dozen more people on now.
Hello? Hello? All right, I think that's George, do you have any questions?
I don't. There are about a half dozen people on now.
Oh, the only person I see here is you. Well, does anybody else have a question? Here, I can switch back to, if I stop sharing, what happens? Okay, I appear as me. Does anybody want to ask a question? Hello.
Hi, this is Lucinda from UNM Medical Records.
Hi, thanks for calling.
Hi, yeah, so your disc is ready for pickup and we're here till 4:30.
Great, thank you. I'll be over shortly. Bye.
Okay.
So let's see. Because of the phone call, I'm not quite sure what happened. I don't see any question. There's something in chat. Yes, Leanne, good to hear from you. All right, so I'm going to stop recording now, and oh, you're welcome.
So thank you.
You're welcome. I think that this is good advice. Just sort of keep in back of your head, and think about from time to time. Let me see.